Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Well, I hate to say I told you so, but I told you so.
He doesn't hate to say it. He likes to say
I
it.
like to say it. So, we're going to talk about the year-over-year changes in the real estate market.
Yes.
Which literally were exactly what we said would happen a year ago. We went out on a limb to tell the truth, and everybody else just lied to all those people out there.
That's true.
Okay, so if you like charts, this is a great video.
It is. So Todd has some fantastic charts that tell the whole story. So hang tight, watch the video, check out the charts. Please remember to like the video, subscribe, and hit the notification bell.
Yes. Okay. This is from the Zillow May market report. It's the last year. So it's the full summary of the whole last year of real estate. The head of the article says home buying competition pushes prices higher. May 2023 market reports. They went back and did a 12-month look back. Okay, the sub part of the headline, more buyers than sellers, meant impressive price growth even amidst muted sales activity in May. Nothing about interest rates, nothing about affordability, supply and demand. There were more people trying to buy than trying to sell.
So clearly the high interest rates did not discourage buyers.
Did not. As a matter of fact, the typical home value, according to the raw, non-seasonally adjusted Zillow Home Value Index, climbed to $346,856. This is not the median price. This is a indexed number that Zillow has been using for a long time. I think it nets out inflation, all these other things. So it's like a raw number. It's 0.9% higher than a year ago. So what they're saying is nationally, year over year, home prices are up 0.9%. Literally something nobody would have admitted that this was a possibility. We did a video a year ago where we took like 20 different estimates. Remember that? Mm-hmm. And some of them said prices would be up 5%. Some said prices would be down 20%. Mm-hmm. But remember that? So 0.9% higher. There were probably some that were right in there.
I'm sure there were some. You know, you have enough people throwing darts, somebody's bound to get it right.
We're still 0.8% below July and 3.4% above the recent low in January. So we're 0.8% below the all-time high.
Right.
The all-time peak ever high. 0.8%, not statistically measurable. Certainly, Juana, is 0.8% of a drop in home value enough to sell your house, pay all the costs to sell, and get rid of that 2 or 3% interest rate loan that you probably had?
So clearly not only that, but we're not at July to have the year over year, because remember the high water mark was in July of last year. So let's see what the numbers are like for July. You know, give us a couple months, give us until August where we can look back at the numbers in July, and then that'll be a much better way of discerning what actually happened year over year. Now we know that year over year for May, the numbers are up for 2023.
Okay, here's the first chart. This is the index. This chart goes all the way back to probably before 2000. Maybe it goes back to 1995, okay? And as you can see, the reason this thing looks like it's squiggly is because it goes up in the spring and it dips in the fall. It goes up in the spring and dips in the fall. This happens every single year. Even sort of during the housing crash, it was doing this. Although I think just because the thickness of the line they used, it kind of maybe distorts it a little bit. And remember, the bottom of this chart's 0, but it doesn't start at 0. It starts at 100,000, which is where their index starts. Mm-hmm. That's where this index comes from. So remember, median home prices weren't $100,000, or more likely weren't $100,000 when this started. But you can see that we had the run-up post-COVID, and then the normal fall in the winter, or in the fall, the largest one probably we've had, but roaring back, right?
Right.
This is pretty eye-opening, Juana.
It is. You know, look, the market has been volatile, to say the least, over the last year or two. But at the end of the day, homeowners have been the winners. They have low interest rates. They have the most equity they've ever had. We have nationally 42% of homeowners own their homes free and clear. Again, nationally, everybody's got a good bit of equity, much more than they ever have. So overall, homeowners have been the winners.
The curious case of the missing listings. This is not a children's book, okay? There were 23% fewer new listings than last May, a milder year-over-year drop than observed in April, which was down 28%, but very similar to the 22% annual decline in March. Okay, less listings. Why are there less listings? You would think people would be, remember, we were told people would flood the market with more homes than were on the market in 2000, would make 2006, 7, and 8 look like nothing. Everyone would flood the market to sell before the market crashed. So where are all the sellers if the market's going to crash?
The sellers are hunkered down. They're not budging. It's very hard for a seller who either owns their home free and clear or has a mortgage somewhere under 4% to look out there at these interest rates that are, 6.5%, 6.75%, and say, hey, yeah, I'm going to go ahead and get rid of my 3.5% mortgage and sign up for a 6.5% or 6.75% mortgage. They don't want to do that. It doesn't make financial sense. So they're just kind of taking a wait and see attitude. Obviously, at some point, the dam will break and sellers will come to the market because their life circumstances make it untenable for them to continue in their current situation. But that's going to be a while. Look, in the last few years, we've gone from homeowners staying in their homes for 7 years on average to 10 years on average, now to 13 years on average.
Just in a decade.
Right. So that kind of lets you know that it's going to be a while before these homes turn. Not only that, but there's a lot of frozen inventory, and we've talked about that before. The frozen inventory are the homes owned by investors, whether they be mom and pop investors or the mutual funds or the hedge funds or whomever owns these homes. They're going to take even longer to turn these homes because they're profitable. So there's very little inventory coming to market at this point with higher interest rates. And even when interest rates moderate, we're still not going to see a lot of homes come to market. Certainly not enough to satisfy the demand.
Here's another eye-opening chart. This is the raw number of new listings. Now, the reason this is like the last 5 years of it. And as you can see, they rise in the spring and then they drop off in the fall. So 2023 will do the exact same thing. But what you notice about this is that 2023, where we are, this is the May report, we are already lower than every one of the last 5 years. Meaning this is pretty eye-opening. So this thing is going to drop off just like the other ones did, and it does not look like we're going to get any significant number of listings that come on the market. It is going to be pretty painful, I think.
And the thing to keep in mind is we have lower inventory, even though when you look back 5 years, we actually have more homes in the U.S. than we did 5 years ago, naturally, because we've had homes that were built, right? So that's really more troubling than anything, because that just is an indication that it is likely that the low inventory will persist for a lot longer than anyone expected, which means that any home that is worth having is going to get snapped up. It's going to receive a lot of attention. It may receive multiple offers depending on the market. So, as always, a home that is a good product will sell quickly. And I think that the homes will continue to sell much more quickly than maybe they normally would because of the lack of inventory.
The other thing, this is the next chart. This is the newly pending listings. This is the number to go under contract. Now, remember when people are saying year over year, but Todd, year over year. Yes, but those top two lines are 2021 and 2022, the hottest years ever. We're the third hottest year ever because we're higher than 2018, 2019, and 2020. You can see the chart right here. There were more listings transacted in May that went pending than 18, 19, and 20, which were arguably the last three relatively normal years. So forget the year over year stuff. Remember, everyone, a year from now, you know what they're going to do? They're going to all want to compare everything to 2022. Oh, but remember, compare it to 2022. They're going to be like, Dad, tell me a story, but compare it to 2022.
Right. So here's the thing. 2022 was an anomaly, and people will use it to sway opinion and to make a point that really isn't relevant to the greater picture of what happens in a normal real estate market.
The other thing that they talked about, and we got more cool stuff here, so don't go. Rents continue to grow, but slower than normal. Mm-hmm. So rents are still increasing. Asking rents climbed 0.6% month over month. So it's about a 7% annual rate. Mm-hmm. Okay. A nearly normal monthly growth rate for this time of year. Rents are now 4.8% higher than May of last year and have climbed only 1.9% this year to date, a somewhat slow start to the year. But if you're a landlord, you're still doing better than if you're a tenant. Mm-hmm. That's sort of the argument here, right? Is that, are you better being a tenant or a landlord? And really, anyone who's been a tenant, we get people who come on the thing and they rant in the comments. I feel bad for them, but they're tenants, and they're like, there's this sort of fight brewing between people that own the homes and the people that pay for rent, because they don't understand that, the costs of people that own the homes have gone up and the rents are following, because that's their market forces. No one's going to buy you a house to live in and let you live in it cheap, right?
Right. So, the other thing to keep in mind is that rents kind of go hand in hand with inflation. Some people will say that the rise in rents are what triggers the inflation, or vice versa, chicken and the egg, right? But the bottom line is the cost of everything goes up, including rent.
Here's the Zillow Observed Rent Index. It goes back to probably 2015-ish, all the way on the left. And you can see that back then it was probably $1,300 a month was what it considered median rent. And then however it's indexed or whatever they measure, and it's up to over 2,000, mm-hmm. which is pretty substantial increase. That's 50% increase in rents. Think of all the people back then who said, I could rent a house for $1,300 or I could buy it for $1,600, but I'm just going to rent it because it's cheaper. And then, of course, they bought it, and then they maybe refied it, and their payment now is probably $1,200. Mm-hmm. And then their friend who didn't ever buy is paying $2,000 plus, because that's what they are in Vegas. They're like $2,100, $2,200 median rents here. Right.
So, we know that people who choose home ownership generally do better because they're building equity. They get the tax deduction. They have stability as far as their monthly payments and monthly housing expenses. So we know that homeowners generally tend to do better. It doesn't happen every single time. It's not in all markets, but generally that is the case.
Okay, somebody asked in the comments. They said, what about the shadow inventory? What about those homes that were all foreclosed that the banks have just been sitting on waiting to dump into the market?
They're getting stacked up with all those homes that were in the shadow inventory back in 2012.
Okay.
Because in 2012
so they're going to double whammy. These homes have been sitting vacant.
So, yep, there are millions of homes that have been sitting vacant since 2012, and they're just getting piled on to those.
They're just going to dump them all at once. They're just going to release all of them into the market.
Yeah. So shadow inventory is not new as far as the rumor mill goes. It's more than 10 years old, and maybe it'll just remain in the shadows.
Maybe that's where they're putting the aliens from the UFOs that we've been seeing on TV. The aliens from the UFOs, their government has taken the houses and they put the aliens in them.
I'll go with that.
Okay. What about the recession?
So the recession, it's coming.
It's coming.
It's coming. 100%.
What's the song again? The recession is coming. I forgot the song. It's so stupid.
Okay. So the recession is coming. I promise there will be a recession.
There will be.
With a
capital R.
I don't know that it'll be this year. I don't know that it'll be next year.
Goldman Sachs does.
Goldman Sachs. likes to put out white papers to remain relevant.
Yes, 25%. There's the entire 25% that there will be a recession of any kind. And there's a 75% chance there will not be a recession in the next 12 months.
Right. So there will be one, maybe 2023, maybe 2024, maybe 2025. At some point there will be one.
Yeah, there will be one. Well, we had one last year, but then it got waived off on holding call.
Yes.
It was a holding, loss of down, 10-yard penalty, and the recession was waived off.
There you go.
Yeah.
All right, next.
Well, okay, that was it for the charts.
That was it. Okay.
Okay. So bottom line is home prices do not look like they're going to crash. We said back in May, June, adjustment. We use words like adjust, moderate. There would be volatility. We did say inventory would probably get back to a normal level. Mm-hmm. Everything we said exactly happened. We even said home prices could drop 5 to 8% in some higher end certain markets like Vegas. Vegas is still down year over year, not that much, certainly not enough to have panic sold. We do know a couple people that panic sold in 2021. Huge mistake because they're still out $80,000 of equity and they're paying quite a bit in rent.
Right.
Yeah.
So was this interesting, useful? Did you like the charts? Did Todd keep the charts up long enough for you to be able to see them?
I did. I kept them up painfully long.
Okay. Please leave us comments. We want to hear from you. Please be nice to one another in the comments. Tell us where you're watching from and what interests you, and we might use your suggestion on a video. Please remember to like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.